In this video, I will teach you 3 different methods to find your daily bias. So let's get on with the video. All right, so the very first method is called the turtle soup method, and this one is the easiest out of like all of these 3. All right, so all you have to do is look for a previous high or low to be rated. So as you can see over here, what we have is a higher high, higher low, and then a higher high. We took out this higher high on a daily time frame. Once you have price taking out the high on the daily time frame, right, you want to wait for price to close above this high. Okay, what it's going to do is going to tell a lot of people that, okay, price has now closed above the previous high. Now price is going to go up. They will consider this as a breakout. But what you have to do now, once price closes above a high, right, in this example, then you wait for a daily candle to close below this high. All right, so firstly you have to wait for the one candle to close above the high, right? When the candle closes, you have to wait for price to come back. So the next candle, right, let's say daily candle closes up, right, then you have to wait for price to come back below this leg high, right, and then close. Once the candle closes, now this is where you have to wait for price to come back and retest this level high. Once price comes and retest this level, your bias instantly switches to being bearish. Okay, this is very easy and it works most of the time. So let me repeat this again. You have a higher high, higher low, and then a higher high. You wait for price to come back and close below here. So firstly, you wait for price to close above the high, right? And then you wait for price to close below. Once the price closes below the high, you wait for a retest. Once price retests this level, you instantly switch your bias to being bearish. It's very easy. And once price hits this line that I've drawn, like this is the retest level, you are going to be bearish. Okay, so similarly you can see around here, what do we have? We have a lower low, lower high, lower low. We left out this lower high here. So now we wait for price to take out this high, right? You wait for price to close above this level. Once price closes above this level, you are simply waiting for price to come back and close below this high. Once that happens, the third step here is to wait for price to retest this high. Once the retest happens, your bias instantly switches to being bearish. It's very, very simple and very easy, guys. Anyone can follow it, okay? So look at this piece of price action around here. So what do we have? We have a higher high, higher low, and then a higher high. You can see that we have a close around here. So the body closes here, right? Now that is step number 1 done. Step number 2 is you have to then wait for price to close below this high. So this is the high, the body closes here. Now step number 3 is wait for a retest. So over here you can see we have a retest, and then you get 1 and 2 days of full bearishness, if that makes sense. Over here, what do we have? We have this low here, right? So price takes out this low. Now that is step number 1 done. Then you wait for price to go up, right, and close above this low, right? So this is the low, the body closes here. Now you wait for a simple retest. Once the retest happens, you can see that we have a bullish day here, right? Then price comes here, and then we have another like consecutive bullish days. Now, when is this invalidated? So let's say that you have a body closure above the high or the low. So in this example, you can see we have a body closure above this low. Now, if price takes out this low here, right, without going up, now that is an invalid bias setup, if that makes sense. All right, so you would not be looking at that price action anymore, right? So over here you can see we have a body closure, and then we have price going up again, closing above here, retest, right, and then we have a push up. Over here, looking at this, what do we have? We have this low, price takes out, closes here, step number 1 done. Then we wait for step number 2, which is price going up and closing above. Now we're simply being patient enough and waiting for price to come here and retest this level. Okay, so another way to invalidate this is when you have this low here. Look at this, lower low, lower high, and then a lower low, right? If the lower high is rated before a retest, right, then that setup is invalid. Did you understand what I said? If you don't get a retest and price takes out this lower high, then that setup is also invalid. Okay, so you would be looking at different things now. So you can see we have a retest, price goes up, and over here you can see we have another lower low, lower high, lower low, price closes here, right? Then we have a push up, the body closes here. On the retest, we switch our bias to being bullish, right? And as you can see, our price goes up and takes out this level, right? And then once price takes out this level, what do we have? We have another body closure. Step number 1 done. We wait for then price to come back and close below this high, which happens right here, as you can see. And on the retest, we can see we have a bearish day, guys. It happens every single day, right? And yeah, this is like the easiest method, guys, and it works like a charm. You can go and test this on your charts. Of course, it's not going to work 100% of the time. For example, over here, you can see that we have this level here, right? So we took out this. Actually, it did work out. My bad. So you can see we have a retest, and then we had a bullish couple of days here. Let me find an example where it didn't work out. So going around here. All right, so I would say that this didn't work out because you can see on the retest, we went down, but then we had a little bullish day, but it just doesn't really, call it what, I would say a valid setup. But over here, what we can see here is that we have another rate, body closes, right? Step number 2, wait for body to close above. When happens? When that happens, you wait for a retest, a simple retest here, and price goes up. So this is a very easy way to find your daily bias, guys. Once you have a retest, you can go onto your lower time frames and look for setups. All right, they will be there every single time. And this is, remember, this is the easiest method. And then I have the third one is actually my most favorite. So make sure you keep watching till the end because that one has an insane win rate. Insane, I wouldn't say win rate, but success rate, if that makes sense. All right, so now that we know how to find your bias with turtle soups, let's get on to the method number 2. All right, guys, so here is the method number 2, and that one is external to internal liquidity. So what is an external and internal liquidity? External liquidity is basically any high or low, right? So this low here is an external liquidity. This high over here is an external liquidity. This high over here is an external liquidity, and this low here is an external liquidity. What is an internal liquidity? It is basically any fair value gap in the discount or in the premium. All right, so over here you can see we have this fair value gap in the discount. So what price does is it takes external liquidity and it rebalances itself into internal liquidity. What I mean by that is price takes out external liquidity and then it goes to internal liquidity every single time. It has to rebalance itself, but there are some rules to it. Okay, so over here we can see we have taken out external liquidity, right? This is the high, so price takes out this external liquidity. Now, how do we confirm that price is going into that fair value gap? So there is a method. So once on the daily time frame we have taken out the external liquidity, we have to look for a market structure shift on the 1 hour time frame. So once price takes out the external liquidity on the daily time frame, we simply look for a market structure shift on the 1 hour time frame. Once we have a market structure shift on the 1 hour time frame, we can simply look and frame our trades and target this fair value gap as our draw on liquidity. All right, it's very simple, guys. So here are a couple of rules. Now let's say there is a fair value gap in the outside above the discount level, and then there is a fair value gap in the discount level. So which one would be your draw on liquidity? This is the question that gets asked a lot of times, and this will be answered today. So this fair value gap is not in the discount, but this one is. You have to target the fair value gap that is in the discount. That is going to be your draw on liquidity. All right, now what if there was no fair value gap in the discount, but there's a fair value gap above the discount level, right? Yes, you can target that as well. Okay, just if there is a fair value gap, there are like multiple fair value gaps, and you have one fair value gap in the discount. Now that is going to be your main draw on liquidity, guys. Okay, but as I said before, if there's no fair value gap in the discount, you simply target any fair value gap that is there. However, make sure once you get a market structure shift, the price has already not filled that fair value gap, because if price fills in that fair value gap, then that setup is invalid. Yep. So very simple, guys. We go from external to internal, and that's pretty much it. So all we have to do is look for a market structure shift, and that is gonna, on the 1 hour time frame, that is gonna confirm our direction. So let me give you guys a couple of examples. So as you can see over here on the daily time frame, we take out this external liquidity, and then we have this tiny fair value gap in the discount level. So let's go to the 1 hour time frame and see what happened. So zooming out a bit, you can see we took out this daily high, which is an external liquidity. So now we wait for a market structure shift. So simply, we did not get a market structure shift, right? I would have to see this low broken in order for me to consider it as a market structure shift. But then you can see price went up, right? Created this higher high, higher low, higher high, higher low, a fractal low, higher low, right? And then we have a higher high, and then we have a market structure shift, and then we have this clean auto block that you could have framed your trade from, right? And yeah, we filled in this fair value gap. So it happens every single time, guys. Let me give you guys a couple more examples. So over here, we have this external liquidity. Price takes out this external liquidity, right? Zooming in, we have this fair value gap. Price fills in this fair value gap, right? And going over here, you can see we have taken out external here again, right? This is the fair value gap. Price fills in this fair value gap. Then we have, let's remove this. Then we have this low here. Price takes out this low. We then look for a 1 hour market structure shift. Once that happens, we can keep longing until this fair value gap is hit, right? So this is fair value gap that gets filled. Price then reverses, right? Then we have taken out this low, fills in this fair value gap. Then we have a purge on this external liquidity over here. So let me remove this. Over here, we have this fair value gap. Price fills in. Actually, it was filled, so let's just not look at it. Because here you can see that the fair value gap was filled, okay? So over here, what do we have? Well, let me remove this. This was not valid. This right here, we take out external. We have this fair value gap, right? And it just keeps on happening, guys. Over here, we have this low. Price takes out this low. What do we have? We have this huge fair value gap, right? Price fills in this fair value gap. Then we have a reaction to the downside. Very simple, guys. I hope by now it is clear what is an external and what is an internal liquidity, right? If you want to learn more about this, I will make sure to link the videos in the description so you can go ahead and watch those as well. So now that we have known about external and internal liquidity, right, let's move on to the method number 3. And this one is going to blow your minds because I have never taught this method before. So yeah, let's get on. 1, 2, 3. All right, guys. So here is the last method on how I find my daily bias, right? And this one is, I think, one of the best ones because it has a very high success rate. So let's get on with the method. So before moving on to the method, I want to talk about my community because I really do it. So just for $97 one-time payment, you can join my community and my mentorship. So what do you get after $97 one-time payment? You get a private Discord server where I share my own analysis. You get monthly course update with new videos, weekly Q&A, and more. And then you have an awesome community of successful traders, right? What do you get? So you get SMC basics if you are just starting out. You get all the basics that you need to get started. Then you have the basic trading strategies, right? For people who just want to be on the charts for like 5 to 10 minutes per day and take their trades. And then we have the ICT essentials. These are the essentials that you need to watch and need to learn in order to trade successfully. And then we have the advanced trading strategies in detail. So we have the market maker models, we have the second distribution entries, and then I call this one the Holy Grail. I mean, you know, a lot of people think there's no Holy Grail, but yeah. Anyways, I have some proof here, right? Past some, this is like very old. I have a couple more challenges passed on my Instagram, so you can watch that. Then we have some proof of students passing the challenges, then got some other proof here as well. So yeah, it's not necessary, but you can just get in for $97 one-time payment, and this is going to be the best investment you are ever going to make. So let's move on to the method number 3, which is the high-low method. So all you have to do is look for a low or a high formation. Okay, so what is a low or a high? So in this example, we have this low. So we have this is a 3 candle pattern, right? And this is like a beginner stuff, but you must know it. So I'm going to teach it anyways. So this is a 3 candle pattern. All you have to do is look for 3 candles, right? So the mid one is the lowest, right? The first one is high and the third candle is high. So you see these wicks, right? The mid one has to be the lowest. The first one, the left one, is, you can see it's higher than this low, and the low of the third candle is also higher than this low. So once the candle closes here, now that is what I call a complete low. Similarly, if I invert the chart here, it goes same with this. So for a high, you have to look for a 3 candle pattern, right? It's gonna be the mid one is gonna be the highest, the left one is lower than the mid high, right? The mid one, and the right one is also smaller than the mid one over here, accounting the wicks here. So I hope I explained it clearly. So let's re-invert the chart. So how do you actually find the bias with this method? It's very simple. So now this is very optional. It either has to, this has to either form on a key level or it can form anywhere. So once this low in this example is formed, you mark out the high of the third candle. Okay, so once the third candle closes, now that is what is going to be your draw on liquidity, guys. This is very simple and very powerful. Once you have a close, the third candle closes, we have a complete low formed, right? Now the high of the third candle in this example is going to be your draw on liquidity. So what you have to do now is, this is a very a little advanced method. So once you have the candle close, right, you have to look for a midnight open. Okay, so what is the midnight open? It is basically the 12 a.m. New York time. Okay, so let's do something here. Let me just put this like that. Let's say this line here is from where the algorithmic day starts, right? So the normal day starts at 16, right? But then we have the algorithm, where the algorithm starts operating is at 12. So now zooming in into this period, right? Let's, on the third candle, right? Let's go to the 15-minute time frame. So the daily candle closes, right? Once the candle closes, let's zoom out to the 15-minute time frame, right? And this is the high over here. This is the daily high. This is the high that I marked out, right? So now what you have to do is wait for your midnight opening. Okay, so let me just decrease this a bit over here. So let's say that the midnight open, which is around here. Sorry guys, I'm trying my best to explain this because this is a little complicated. So once you have this low formed, right, you have marked out the high of the third candle, and then you wait for a, this is the high, right? Okay, basically when the candle closes, you have to wait. I'm messing this up, but just stick with me around here. I'm going to explain it, so be careful, just keep watching. Okay, the day closes at 16. Okay, this is when the daily candle closes. So let me just put this out like that. It's going to be 16 New York time. Okay, this is when your day closes. Now you're simply waiting for a midnight open. That is going to be the 12. So going here, price must not violate the high. Okay, it must not break the high. If it does that, then no, you're not going to take that trade. So you simply look for a midnight opening price, and then you have to buy below the midnight open. So this is, let's say, the midnight open, right? You wait for a liquidity purge on the 15-minute time frame, right? So we always want to buy below the midnight opening price. So at 12, this is going to be the midnight open. Let's say there's a candle that opened at 12. You want to buy below it. So wait for price to take out liquidity, right? And then you simply wait for a market structure shift on the 15-minute time frame. You take your entry on the 15 minutes and you target the previous day high. Very simple, guys. Very easy. Let me give you guys a couple of examples, and it's gonna make everything crystal clear. So yeah, let's move on. All right, guys. So here is the example number 1 for the third method. So as you can see, what do we have here on the daily time frame? I'm looking at Euro GBP, and we have a swing low formation. So we have 3 candles, 1, 2, 3. The mid one is the lowest with the wick here. The first candle is the is not longer or you know, it doesn't breach this low, and the third one also doesn't breach this low here. So now once that day is closed, right, what you have to do now is you have to go to the 15-minute time frame. Once you do that, you have to simply look for your midnight open, right? So at the moment it is 16:45, so we have to wait till 12. All right, so going over here, you can see that around here we have our midnight opening price, right? So that is when the 12 a.m. New York time hits. So now we are simply looking to buy below here, okay? We're simply looking to buy below the midnight open because our draw on liquidity is this previous day's high, right? So now what we have to do is to look for a simple liquidity sweep. So we have this liquidity purge around here. Now we have to look for a market structure shift on the 15-minute time frame. So right around here, what do we have is going around here, we have a market structure shift, right? And we also have this consecutive bearish candle. So that is an auto block. So I would simply take my entry from this auto block going long here, right? Putting my stop right below this low, and I would target this level here. So let's see how this plays out. So as you can see, that we have hit our take profit level. Now this is a model, a trading strategy itself. You can use it by its own. All you do is wait for a swing low or a swing high formation, and then you mark out the high or low of the third day, right? And then you look for a midnight open. If your bias is bullish, you look to buy below the midnight opening price, and if your bias is bearish, right, you look to sell above the midnight open. You have to look for a liquidity sweep below the midnight open, right, or above the midnight open, if that makes sense. Let me give you guys one more example, and then I will end this daily bias video. All right, guys, so here is the last example for the method number 3. So over here, where you can see we have a swing low formation here again as well. So we have a 3 candle formation, right? The middle one is the lowest. Then we have the first one, which doesn't breach the low of the mid one. And then we have the third candle, which doesn't violate the low of the mid candle as well, right? So now we have a clear swing low. We also take out this sell side. So now we mark out the high of the third day, right? In this example, if we were let's invert the chart. If we were bearish, if we were going short, we would mark out the low of the third day, right? So let's reinvert the chart here. So now let's go to the 15-minute time frame, and we want to be buyers. So this is our draw on liquidity. We want to be buyers below the midnight open, right? So let's wait for the 12 a.m. to hit. So that is when we have our opening price. So this one here, right? Now we're simply looking for a liquidity sweep, and that happens right there, as you can see by this candle. So now we will wait for a market structure shift. That happens right there. Then we have our auto block here. So I would simply go long here, put my stop right below this low, and I would happily target this level going for 6.52 RR. So now we got our entry, and the take profit was hit. As you can see, price came back into our auto block here, right? We didn't violate this low, and it just hit for 6 RR. I hope you guys enjoyed today's video. Make sure you hit the subscribe button. We want to hit 100K subscribers by the end of this year, and I'll see you guys in the next one. Goodbye. Mwah.